But the medicine is also very tough to take, and millions of Australians with a mortgage are feeling that pain right now. Now, rate rises began before the election, and then they rose by a full % across June and July, and the Independent Reserve Bank has told us to expect more to come. There's no use pretending that these rate rises don't hurt. They do, and they will. Every extra dollar Australians have to find to service the mortgage is a dollar that can't help meet the high costs of other essentials. Now, governments shouldn't make it harder for the RBA on the demand side, but more than that, we should be working to address problems on the supply side, and we are. Some of the conditions determining this inflation problem are outside of Australia's control and largely unavoidable. As much as we can provide support, we can't control the war in Ukraine or China's COVID policies. Floods and new COVID variants bring the supply chain disruptions and worker absences that we've been experiencing. But there are things that we can control, and some of these conditions have been building for a long time and were entirely avoidable. A decade of energy policy paralysis with not enough investment in cleaner and cheaper and more reliable energy and not enough certainty for investors, that's pushed up power bills. A lack of the right investment in skills and local manufacturing capability, that's seen our productivity flatline and supply chains break. And an objective to keep wages low as a deliberate design feature of the economy, that's contributed to a decade of stagnant pay. And let's be really clear about something. Inflation is high, and in the near term it will get higher, but the primary cause of this is not higher wages. Nowhere near it. We don't have an inflation problem because workers are earning too much or because we're in some kind of wage price spiral. Real wages growth over the past decade has averaged just 0.1% a year. In the year to March, real wages fell 2.7%, the worst result in more than 2 decades. And once wages data for the June quarter is released in a few weeks, it's likely this fall will have accelerated, given yesterday's inflation outcome. So the wages of Australian workers are not causing this inflation. The fault lies with a decade of wasted opportunities and wrong priorities and willful neglect that Australians are now all paying for. Mr. Speaker, this is the context for the updated Treasury forecast for our economy that I am releasing today. Now, forecasts are never perfect, but these better reflect the economic circumstances our new government is now dealing with, compared with what was set out before the election. In the pre-election forecast released a little more than 3 months ago, inflation was expected to peak at 4.25%. It's already 6.1% through the year to June, and now forecast to peak at 7.75% in the December quarter this year. The current expectation is that it will get worse this year, moderate next year, and normalise the year after. We haven't reached the peak yet, but we can see it from here. Treasury expects headline inflation at 5.5% by the middle of next year, 3.5% by the end of 2023, and 2.75% by the middle of 2024, back inside the RBA's target range. Inflation will unwind again, but not in an instant.